Another video lecture, and we'll go ahead and get right into it. Today what we want to do is we want to add depth and insight to the concept of elasticity and government intervention. And the reason we want to do this is to get you ready for Paper 1 essays. IB doesn't want you to just explain concepts. Often they want you to show that you have insight and depth. You can discuss a concept, you can analyze it and look at it from different perspectives and examine implications on different groups, and they want you to, basically to show that you're able to really sort of think about it not just broadly but deeply. So that's what we want to kind of add for you today, and let's get right into it. Our learning goals. 1, we want to relate additional analysis points to the concepts we've been learning of elasticity and the different types of elasticities, whether that's PED or XED or PES. And then we also want to look at additional analysis points as it relates to government and intervention, or government intervention, like subsidies and taxes and price floors and ceilings. Often IB would like it if you can somehow connect real-world examples with your discussions. If you can somehow show that you can bridge the gap between practice and theory, that's good for your paper as well, because it's showing that you can not only look at it in theory, but you can see what the practice is and what the real-world sort of reality is of that theory. And prior to each sort of analysis point, we're going to look at an IB question. That way we can kind of see, what IB, how IB might want us to analyze or to explain or to show knowledge relating to one of these topics. So let's get right into it. The first concept we'll be tackling is PED, price elasticity of demand. And our past paper question is this: explain the importance of price elasticity of demand and cross-elasticity of demand for business decision making. And for this question, let's just concentrate on PED, so the importance of PED and business decision making. PED, we all know that it's price elasticity of demand, and that it's a measure of responsiveness of a change in quantity demanded due to a change in price. If you were tackling this question, this is actually a half-page part. This is part A of a paper 1, and it's a half-page response to maybe 1 page at most. And you would want to define PED, maybe show that you can calculate it like we just talked about. And you would want to show a diagram that shows a relatively either inelastic curve as seen on the right, or a very elastic curve as seen on the left. So, that would be the first part of the question, but the question asks, why do businesses need to know this? And you'd have to explain that. So let's look at, why does it matter? Why does PED matter for firms and for governments? And we'll talk about that too. So firstly, it matters because it informs pricing strategies, and it basically tells firms what the changes in market prices will do to revenue. And let's go ahead and let's take 2 examples, and if you could put this in your paper too, you would give an example, and you could say the price of cigarettes is very inelastic, like the diagram on the right, and you could say that if the price were to rise, and maybe that's not cigarettes. Cigarettes obviously aren't 50 cents going to €1.50, but whatever item it is, give something inelastic, and you notice that if the price changes from 50 cents to $1.50, we have a pretty large change in price in proportion to the change in quantity. We have a relatively small change in quantity compared to the change in price. So that tells the business that if prices rise, they're actually going to end up making more money. And if you think about it, you look at the diagram there, if they were at the first point of 50 cents and 5 units, you know that at that price of 50 cents and 5 units, they're selling $2.50 or €2.50 worth of goods and services at that price. However, prices were to rise to $1.50 or €1.50, and the quantity was to drop to 3, the firm would now be making 4 euros and 50 cents or $3.50. So ultimately, PED matters for firms because it tells them if there is a change in price, how much will this impact revenue? And so they would want to know if their item, how inelastic it was based on, or they would want to know how inelastic it is just to determine the changes in the market or the changes in revenue. Also, if you're a firm and you have the ability to set your price based on the level of competition in the market, you may, if you have a very inelastic item, you would want to raise the price. Conversely, you look at the diagram on the left, you see a very elastic curve. If you have a very elastic good, you would probably want to lower the price because a small reduction in price is going to mean a lot larger volume of sales. And so you can kind of see that on the diagram on the left. So again, it's important for firms in not only understanding how changes in supply and demand will impact revenue, but also in pricing strategies if the firm has the ability to do that. So you would want to answer the question that way. So just note also if if it is an inelastic good, you would want to raise the price because, again, the price will go up by a lot larger proportion than the quantity will go down. So you raise the price, you're still going to sell a lot. However, if it's an elastic good, you want to lower the price because a small drop in price will result in a much bigger increase in quantity sold. So that's just one little other piece of information. Also, the opposite, if you wouldn't want that to happen. If you were a firm that had a very elastic good, like the diagram on the left, and your price went up by a little bit, you would have a huge drop in sales, so that would be very bad for your firm. Just like if you had a very inelastic good and the price dropped. Price dropped for an inelastic good, you're going to have a much bigger drop in price, but a very small gain in quantity. So you wouldn't want to drop the price if you had an inelastic good. Finally, one other thing to note is why governments and taxation policy. Governments tend to tax items that are PED inelastic, and that is because a tax will cause the price to go up on an inelastic good, but the quantity demanded will not go down by much because if it's something that's inelastic, again, change in price is much bigger than a change in quantity. And this is good for the firm in that it doesn't force the firm out of business. A change in price is not causing the firm to go bankrupt as they have lost a huge quantity of sales. Moreover, the government is able to get revenue from this. So even though they raise the price, because it's inelastic, people still want to buy it. So the government, one, gains revenue to run government programs, and two, the business that is selling this good is not suffering a huge loss in quantity. And so the business is able to stay running, and also the government is able to gain revenue. So hopefully, based on our last question, why is it relevant for businesses? You can now answer that. Let's go on to our next concept and our next question, which is XED. And before we do that, or actually it's not XED, it's PED and PS. Before we do that, I guess one other kind of important note, I almost forgot, is if you were writing this in an essay, not the question that we showed was a 10-mark question. It wasn't an essay question. But if you were given an essay question about PED and you had to discuss PED, one bit that you could always throw in about the statistic is that PED is very, very difficult to calculate. We know that it's a simple formula, but the thing is the statistic doesn't take into account extenuating circumstances. There's so many other factors like number of competitors, the market that it's being sold in, the price in that market, and versus the competitors' prices. I mean, PED is as a concept, is very, very narrow and doesn't take into account all these other factors. So the information, as far as firms that want to gather this information and use it, is very limited because it doesn't take into account all these other factors, which sort of limits the validity of the statistic because it doesn't look at all these other things. Okay, next concept, PED and PES. Let's look at our question. It says the price elasticity of demand and the price elasticity of supply for many primary commodities tend to be low. Explain what is meant by this statement and how it contributes to the problem of price instability for primary commodity producers, it should say. Here's another very similar question from another past test. Explain the why price elasticity of demand of primary commodities tends to be relatively low, while the PED for manufactured products tends to be high. So let's go ahead and look at some more information relating to that. PED and PES. We've just defined PED. We know what that is. PES, price elasticity of supply, is a measure of responsiveness of a change in quantity supplied due to a change in price. And again, we're just looking at the steepness of these two curves. So if you got those questions, you would first want to define those two terms, and you might want to put in a diagram that shows a very steep PED and PES curve for the first question. The second question, you might want to put in an inelastic or an elastic curve as well, just to show the difference. So let's try to answer that question to some extent. Primary commodities are inelastic with both concern to PES and PED. Why is it? Why is that? Why are they so steep? Well, PED, the demand for most commodities, tends to be inelastic. And just to kind of give you an example, most commodities, we think of raw materials, resources, things like minerals, agricultural goods like wheat and rice, things found naturally in nature, wood, metals, anything like that. These tend to be very, very inelastic, and that is because, one, quite a few of these goods are necessities. Rice and wheat are things, very, very important foodstuffs, and things that are necessities tend to be very inelastic. Two, these necessities tend to be pretty abundant and pretty cheap. When things are pretty cheap, it tends to be that those goods are inelastic because people are not price sensitive to cheap things. If price goes up on rice or wheat, people are probably still going to buy it because it's already fairly inexpensive. The PES for both those types of goods, rice and wheat, also tends to be pretty inelastic because it takes time to grow them. And so you can kind of see in the example in the bottom left, we have two very inelastic curves. If demand goes up on rice or wheat, the quantity supplied doesn't go up by much, and that is because businesses cannot create output in the short run very quickly. I mean, think about it. If you're growing rice and the price of rice goes up, can you just grow more, in the next week or 2 weeks? No, you can't. So again, an increase in the price does not usually lead to much of a change in quantity supplied. So that is kind of why they're both inelastic. Why does this contribute to the price volatility that was kind of asked about in the first question? Well, if you think about it, because the curves are so steep, if anything shifts, the change in price is going to be large. Because if either demand or supply shifts, we're going to see a much bigger change in price than we will in quantity. So if there is any change in this market, most certainly the price will change a lot more than the quantity. So this is sort of the main contributor to the volatility in these primary commodities. Another thing to note too, and this is kind of a sad reality, is that many LEDCs, which stands for less economically developed countries, produce mainly primary products or primary commodities. And because these commodities are inelastic, they have kind of been subject to really, really large changes in price and not so much in terms of quantity. And so it makes things kind of unstable in those countries because the revenue for those workers shifts so dramatically. So it shifts dramatically. Another thing to think about too with regard to many LEDCs is supplies of a lot of these goods have been rising. Many primary commodities, just countries keep making more and more and more of them, and there has been increases in supply, which has been driving prices downward for the past 40 years. And this is something we'll talk more about in developmental economics, but it is important because the countries that are relying, these countries that are relying on export revenue, have not been able to earn a lot from the sale of their primary commodities because prices have been going down and the quantity hasn't been increasing much because they're inelastic goods. Even though the price changes by a lot and it goes down, the quantity doesn't shift by much. So they're selling about the same amount but for a much lower price, so it kind of hurts their export revenue. Now that second question also asked about manufactured goods and LEDs or MEDCs, or just asked about manufactured goods. Just to note, manufactured goods tend to be very, very elastic in terms of both supply and demand. And that is because, if you think about it, first of all, a lot of manufactured goods it's basically anything that's built in a factory: a television, a car, a watch. Anything that's built in a factory is a kind of a manufactured good. And these tend to be very inelastic in demand, or very elastic demand, like the diagram on the right. And that is because these tend to cost more money. Remember, one of the determinants of demand is, or PED, is proportion of income and luxury. Televisions and cars are more expensive things. And when prices go up, people will buy different goods or different substitutes. And so these tend to be price sensitive. And so if there is a change in price, it can affect quantity dramatically. You can also think about it in terms of like a television producer or a car producer. If the price drops on one of these items, like for example, if the price of a Toshiba TV drops lower than that of the Samsung and all the other competitors out there, LG and Huawei and all these other TV producers, if they're almost the same product or a similar product and one is cheaper, people will probably buy a lot more of that cheaper, very similar product. And so the quantity would go up dramatically. So PED tends to be very elastic. PES also is pretty elastic too, because these goods are manufactured, and usually in a lot of these factories there's quite a bit of spare capacity, meaning that it's easy to increase output by hiring more workers and getting more materials. So if there is a change in supply, or a change in demand rather, a movement along the supply curve, usually the change in quantity supplied is probably going to be larger because it's easier or quicker for these firms to increase output. So anyway, hopefully, based on what we just talked about, you can answer those two questions on why is the PED and PES of manufactured goods elastic and primary commodities tend to be low, and how does that contribute to price volatility. All right, well, we're going to go ahead and stop the video lecture here, and we're going to kind of continue on in just a moment with the next step, but it'll be a separate video. Anyways, thanks for watching. Have a nice day, and we'll talk.